In this session, we will discuss how funds flow through the financial system. We will introduce and characterize financial markets. We will then explain what financial institutions are and how they add value. To keep things simple, we will focus on a bank. The financial system channels funds from savers to borrowers in exchange for financial instruments. But who or what is this financial system? That's what we are going to work on right now. It turns out that there are two ways that funds flow through the financial system, either directly through access to financial markets or indirectly via financial institutions. In both cases, borrowers receive their funds and savers receive their financial instruments, but what's interesting is just how that exchange takes place and who is involved. Let's start with financial markets. How can a saver participate directly in financial markets? Well, let's say you wanted to buy a share of Apple. Typically, you will not buy this share from the company itself. Instead, you would buy the share from another investor on the New York Stock Exchange. That's why we denote Apple with this ticker symbol. This type of transaction is what we call direct exchange via financial markets. On the direct exchange part, while we say direct exchange, this type of transaction will usually be executed with the help of a financial firm called a broker or a dealer. For a fee, a broker will find you a trading partner. On the other hand, but still for a fee, a dealer will act as your trading partner, selling you a financial instrument that they carry in their inventory. Nowadays, most of this interaction happens electronically. For example, you may have heard of E*TRADE. This is an online trading platform that offers both broker and dealer services for retail investors like you or me. There are many types of financial markets. We classify them in terms of the type of financial instrument that can be bought or sold. For example, stock or equity markets are where the shares of businesses are traded. Debt markets involve loans, mortgages, or corporate bonds. Money markets are where short-term bonds, those with maturity less than 1 year, can be bought or sold. To make this concrete, when Apple wants to fund its operations, it can borrow by selling equity, long-term bonds, or short-term bonds known as commercial paper. After issuance, the equity will be traded in a stock market, the long-term bonds will be traded in a bond market, and the commercial paper will be traded in a money market. We all know that well-functioning financial markets play a central role in modern economies. Countries with the largest and most active markets all show three qualities. First, low transaction costs. It is cheap for borrowers to issue securities, and it is also cheap for investors to trade among themselves. Second, market participants should be allowed to collect, process, and communicate information about borrowers. This will ensure that market prices accurately reflect potential risks and returns. When prices are accurate, resources will flow to their best use. Third, investor protection. Here I don't mean that investors are protected against losses if an investment doesn't work out. No, I mean that savers need to be confident that borrowers will not rip them off. Financial instruments are legally binding commitments to repay, and modern financial markets require regulators and courts to enforce contracts. When investors are protected against abuses, they will be happy to, well, invest. Next, let's introduce financial institutions. Our goal here is to understand what financial institutions are and how they add value over and above financial markets. Financial institutions are firms that channel funds from savers to borrowers. How do they do this? Well, they first raise funds from the savers. They take those savings and usually provide a short-term liability in exchange. They then take those funds that they've raised from the savers and they send them to the borrowers. By this, I mean the financial institution will invest in financial instruments issued by the borrower. At the end of the day, we still have funds being sent from savers to borrowers, but as you can see, there is this extra step in the process. This is quite abstract, and I'm going to make it concrete in a second, but one final point. A key difference between these financial institutions and the brokers and the dealers mentioned before is that these financial institutions have balance sheets and often make long-term investments. The brokers merely connect savers and borrowers. Let's work through the classic example of a financial institution. If you can follow this, then you are in great shape. How does this process work at a simplified bank? I am the saver. I put $1,000 of my savings in a bank in exchange for a deposit contract. The deposit contract is a liability of the bank. It owes me $1,000 on demand or whenever I want it back. The bank does this many times over. It pulls $1 million in savings. Next, the bank identifies a credit-worthy business and lends that business $1 million as a long-term business loan. That business loan is an asset of the bank. The business owes the bank $1 million. Putting this together, our bank has channeled funds from savers to borrowers. Perhaps less obvious, the bank has created a balance sheet along the way. A $1 million loan funded by $1 million of deposits. Why do we need financial institutions? What is the point? We know that financial markets and, say, banks coexist, so there must be good reasons to have both. Economists have identified at least 3 problems that financial institutions help to solve. First, maturity mismatch. Second, price risk. And third, information asymmetry. Let's stick with banks for now and unpack these points. The first issue savers and borrowers would run into is what we call maturity mismatch. On the one hand, borrowers typically want long-term funding. Home buyers want mortgages for 15 or 30 years. Corporations want funding for projects with long payback periods. And on the other hand, us savers, we want easy access to our funds and even value payment services. We most certainly do not want all of our money locked up for long periods of time. How do banks help to resolve this mismatch in needs? Well, they simply issue deposits that are redeemable on demand and grant loans that are long-term. Next up is the observation that stocks and bonds might not be the most stable store of value. Prices of stocks bounce around from day to day. The fees or bid-ask spread associated with trading might be volatile as well. When we invest in financial markets, these are usually the first issues that come to mind. Some savers might find price risk very off-putting and prefer just to hold cash instead. How do banks help here? Well, once again, we can think of the deposit contract. It is both super convenient and also very safe. I put $1 in the bank today, and in a world with deposit insurance provided by the government, I will be able to withdraw at least $1 tomorrow. There might be some fees associated with bank accounts, but at least there is zero price risk. Final point, and this is a big one. Savers might have a tough time evaluating the risk and expected returns on investments. How much will the investment pay off? What is the likelihood of failure? How big is my loss in the event of default? Here is an interesting case study. Xano, the baby drone. Sounds like a really cool idea. A baby drone for selfies. Investors certainly agreed. Back in 2015, this award-winning idea was Europe's most successful crowd-funded project. It had raised over $2 million of funding from more than 12,000 investors on the Kickstarter platform. Unfortunately, it did not work out. Despite promises, only about 600 drones were produced that could not fly, and the parent company declared bankruptcy. Many of the investors ended up with absolutely nothing. What do we learn from this case? Well, it can be tough for individual investors to first select successful businesses and second, minimize losses when things go bad. There are, of course, market-based solutions to these information problems. Equity research analysts forecast earnings, credit ratings agencies rate bonds. You can even buy bond insurance to guard against potential losses. However, if information risks are too large, then some households might prefer not to invest. This creates a role for our bank, who can meet this information risk head on. Banks are experts at screening and evaluating borrowers. Banks monitor borrowers after granting loans, and banks stop lending to borrowers that are not performing well. Let's summarize what we have just covered. The financial system moves funds from savers to borrowers, and it does so through one of two channels. First, directly via financial markets. In this case, a broker usually helps connect investors that can trade with each other. That way, a saver can purchase securities issued by a corporation or the government. Second, funds are moved indirectly with the help of financial institutions. We have argued that financial institutions can add value by solving maturity mismatch, price risk, and finally, information problems.